The Yogi Economist presents Mortgage 101.
Dumbo boy wants to buy his first home. But, without a mortgage it is not possible. The crafty mortgage broker provides different options. In this video, I will talk about amortization period and mortgage term in detail. In the next video, we will go through open-closed mortgages and mortgage rates in detail. Before beginning these topics, let us have a look at this chart. This chart is essential for understanding mortgage payments. The mortgage payment is affected by both amortization period and interest rate. Interest rate is affected by the three orange color circles indicated by blue arrows. Any change in the orange color circles indicated by the blue arrows make your interest rate goes up or down. Now, let us understand how amortization period affects your mortgage payment. Amortization period is the length of the time to pay off your mortgage. In the first year, most of the mortgage payments goes towards interest. Towards the end of the amortization period, you will be paying more towards the principal as your interest payment will be reduced. In Canada, amortization period depends on the down payment. Insured mortgages with less than 20% down payment are allowed for a maximum of 25 years. Longer amortization period will have smaller mortgage payments. Shorter amortization period will have higher mortgage payments. Longer amortization period has smaller monthly payments. But, the interest paid for the entire period will be higher. This might slow your retirement plans. A shorter amortization period will save lots of money towards the total interest. But, the monthly payment will be higher. You might end up living as house poor. Both longer and shorter amortization periods have their advantages and limitations. Living as a house poor, or taking a late retirement is your option. It is prudent to take longer amortization period and pay off the mortgages with savings. This will reduce amortization period and the total interest. Understanding mortgage term is very critical to get a good interest rate. Mortgage term is different from amortization period. This is the length of the time your mortgage contract is valid with the lender. This can range from 6 months to 10 years. Mortgage term is the number one factor which determines the interest rate. Usually longer the term, higher is the fixed interest rate. On a $300,000 mortgage, you pay $5,000 per year more when you chose 10-year instead of 2-year term. Repeating this same mistake again and again by choosing higher interest rates, you might end up paying up to $50,000 more interest towards the life of your mortgage. Locking into the 10 or 5-year terms might impede you from taking advantages of economic downturn and low mortgage rate. Penalties will be applied if you try to break the contract. You might pay huge penalties up to 3% your home value. Mortgage has to be renewed at the end of the term. This can be with a different lender. Your mortgage broker or bank might suggest 5-year or 10-year term because of the big commission. Save yourself by doing thorough research.